Here, the brand does not matter.
Yeah.
Pricing matters, product matters, and that's all.
Yeah, and the network maybe matters a little bit.
Network matters. In whatever sense you want to say that. I think we're in a place where regional players can be good acquisition targets. So we got to keep an eye on for smaller companies getting eaten up by larger companies who are obviously hungry for market share and price discipline, which may start emerging in the south.
Right. Okay, welcome to another episode of Taking Stock. This is episode 3. Every week we pick one company, we pick one stock, and we deep dive into it. And this week we have chosen the company that is called as the Engineer's Choice, UltraTech Cement. So first thing let's start with is I was obviously going through the research and reading some news articles and everything, and one thing that really sort of interested me or intrigued me is that in December 2024, which is not very long ago, UltraTech acquired India Cements. Now, what was the strategic importance of this acquisition? And if I'm not wrong, India Cements is the same company that owns CSK.
Yeah. So they acquired India Cement, but India Cement and CSK are now separate entities.
Right.
So they just got India Cement and not CSK. CSK is still with the promoter family. But India Cement, a couple of things, right? Number one is why did India Cement sell? There's obviously the promoter's choice and family and succession and stuff like that, which led to the promoter saying that India Cement should be sold to a potential buyer. And UltraTech bought it because primary reason is to strengthen their presence in the south of the country.
Okay.
So India Cement is someone who had a dominant market share, not the highest, but a dominant market share in South India. They're a Tamil Nadu-based company. And it's actually, interestingly, is the first IPO in independent India, is India Cement.
And it's underwritten by Paterson.
Yes, the fun fact.
So, very subtle plug.
So primary importance for UltraTech, or the objective, is to get presence in South India. And pan-India player UltraTech is, they have operations all across North, West, East. They have South as well. It's not that they didn't have South before India Cement. They just wanted to strengthen their position in South India.
Right. So from what I understand, and again, correct me if you think I'm wrong, but the South Indian cement industry is very, very fragmented. Is that the right word for it?
Yeah. Fragmented is the perfect word for it. It's a region that, our demand typically in cement is distributed across regions. Classified as North, West, East, South, and Central.
Right.
Central counts as a separate region altogether. Roughly, everybody has now similar demand coming from all the 5 regions. Growth rates differ, capacities differ, time periods differ, but roughly, let's say it is equally, more or less divided. 5 years back, if I look at, East was very underdeveloped.
Right.
It is now the highest growing market. Right. So market share wise, I think let's just assume it is equally divided.
Right.
The problem with South India is that, okay, so we'll take a step back.
Right.
What is cement made of? The primary ingredient for cement
limestone
is limestone.
I've done my research. I didn't know this.
So limestone is available in mines or quarries. Right? You get the limestone out. You mix it up with a little bit of gypsum. You mix in a little clay or sand. It's not that simple. It's just
sure.
It's a complicated process. And when you heat it up to 1,000+ degrees in a kiln for a prolonged duration, it all comes together, and then you finally make something known as clinker, which is further ground into cement.
Right.
So that's the basic process. Now, limestone is not uniformly, of course, divided across India. Cement demand may be and growth may be. Right. But limestone is going to be geographically present in certain areas.
Okay.
If I look at India's limestone distribution, a majority of the limestone is in the south.
Okay.
So Karnataka, Andhra, Rajasthan are the top 3 states with limestone availability.
Okay.
So top 2 are, of course, Karnataka, Andhra. Telangana has also got a sizable limestone supply available.
Right.
So if I look at the top 6, you've got 3 of the South Indian states in that mix.
Right.
So there is a disproportionate amount of limestone availability in the south. Essentially, what that does is that results in a place where raw material, if it's close by, everybody is going to try to mine it and say that let's make cement out of it.
Right.
So South India has 30 major players in the cement industry.
Because of the proximity of the supply of limestone,
Yes.
that being one of the factors, I'm assuming.
One of the factors. So eventually there is parity in terms of raw material availability.
Right.
Earlier, of course, before 2015 or even before that, limestone licenses or mine licenses they were awarded to companies. Right. We were in a sort of licensing Raj, if you want to call it that. And because of that, there is many players who got those licenses. Distribution became pretty uniform across the south of India. And cement is a business where transportation is difficult.
Right.
You won't ever hear of cement being imported or exported out of countries. It is massive. It is bulky. It is very
see
difficult.
Those trucks causing Bangalore traffic problems.
That is again RMC. That is even more difficult because once you stop RMC from moving,
right,
it freezes.
Right. Yeah, correct.
So RMC is a level tougher.
Yeah, so it's got to have to keep churning or whatever you call it.
So even before that, before the concrete is made, before cement itself is hard to transport.
Right.
So what happens is usually transport cost is very high in terms of the end consumers hit.
Right.
Transport cost is significant. So it's necessary that it's all nearby. And hence, because of that history, South India has a lot of limestone. And hence a lot of
cement players. Yeah.
Interestingly, South India also has a very stable tectonic plate structure.
What does that mean?
Tectonic plates usually cause earthquakes, movement, etc. Right?
But what does that have to do with cement?
No, so limestone availability hence is untapped and available in the south because usually what happens is tectonic movement will displace it. It will cause disruptions, etc. That being a stable region from a geographic standpoint gives you an added advantage.
Okay, that makes sense.
That over millions of years, these calcification happens,
right.
Development happens. Finally, you get limestone.
Right. Fair enough.
So yeah, very fragmented. However, that is changing now, of course. But yeah.
So UltraTech has recently bought over 3 different cement players, India Cements being one of them. Right. So how did sort of UltraTech go about or even envision to solve this problem in the south of having so many different players and having such a fragmented market?
Yeah. So I think we got to delve a little deeper into why this is a problem, right? Because having 30 players shouldn't ideally be a problem. But if you look at the rest of the country, there are 4-5 major players in every region.
Right.
West will have 4-5, North is 4-5. Every region has 4-5 dominant players.
Right.
And then you have a long tail, obviously. But South was structurally different.
So when you're saying there's 30 players, there's essentially nobody who's really dominant. It's all of these 30 are the sort of are the dominant players altogether.
Before UltraTech acquired and before Adani acquired Ambuja ACC, yes. Right. So if you have to exclude if you have to say step back maybe 5 years, then there was UltraTech had its own organic presence.
Right.
Ambuja, ACC, India Cement, Ramco, Dalmia, Heidelberg, Chettinad, Coromandel.
Right.
Players. And
they all had their own sort of customer base and their distribution channels and everything set up, right? Yeah. Fair enough.
Now, the problem in that situation is that when there are so many players, they are also fighting for the same market.
And I'm assuming it's very price sensitive.
Yeah. Exactly. So, problem is extremely high raw material availability. Limited customer base,
right?
Because customer base is not going to increase because
correct.
Limited transportation feasibility options around the country results in pricing war,
right?
Because everybody and cement is a commodity,
correct.
At the end of the day, it is cement, right? It's going to do one job, and if it does that job, people should be happy with it,
correct.
It doesn't. Okay, I'll change that statement a little later, but anyway, so commoditized play, and hence there is pricing pressure. Now, all 30 of these guys were obviously fighting for the same market. When there is not enough demand in their particular sector or area, say, for example, I operate in the 5 districts around where I live. There's not enough demand there. I'll start transporting in your area as well.
Of course.
And I'll start eating into that share. So that is the other problem. And a couple of metrics. So to define how grave the problem is. One is that pricing in the south of India has always been 15 to 20% lesser than the rest of the country.
Okay.
So if everything is operating at say 600 rupees or 550 to 600 rupees per bag,
right?
South India will be at say 500 rupees.
Correct.
So there'll be lesser pricing.
Right.
That's problem number 1. Problem number 2 is that capacity utilization itself is low. Because there is limestone availability and peak demand may be higher, people have set up capacities, but they're not being utilized 100%.
Right.
So while 80% is the capacity utilization on average in the rest of the country, the south of India is usually between 50 and 60%.
Understood.
Now, for any cement company, there is a high fixed cost, right? Because
Right.
you are taking all these materials and burning them at 1,000 plus degrees.
Right.
It requires a lot of fuel. It requires a lot of infrastructure. It requires a lot of distribution after
Right.
that. Facilities, capex heavy. If you're not operating at peak capacity, and if your pricing is not favorable, you're going to result in profitability being suboptimal.
Right.
So it was resulting in a problem where there is high amounts of cartelization, pricing pressure, low profitability compared to the rest of the country. And that's where I think what UltraTech or an Adani see is that if we try to consolidate market share and become majority players, you can start demanding a certain pricing.
Right.
You can command a certain price, you can dictate that, and the market will sort of follow.
Understood.
So it is actually a move that, in a way, tries to bring some amount of price sanity and hence profitability improvement in the entire South Indian market.
So now you're saying that this was the situation 5 years ago, right? And this was how the market was: extremely fragmented, 30 players, capacity not being ideal, pricing not being ideal, right? Almost like a very cutthroat market, right? Now, cut to, let's say, if you had to look at the same market in 2025, I'm assuming UltraTech has taken certain moves to make it a lot better, at least in their favor, right? So,
Yeah.
what does the market look like in current day?
So current day, if I have to look at the market dynamics or the market share metrics, UltraTech will be at the top.
Okay.
Second will be Ambuja and ACC put together, which is now part of the Adani group.
But this is only in the south?
Yeah, we're talking only about the south.
South,
right now.
okay.
Yeah. So south, UltraTech being the largest, Ambuja, ACC put together. Actually, this same equation is applicable for the rest of the country as well. If I have to look at Pan India,
Right.
Pan India, UltraTech is the largest.
Right.
Second is Ambuja, ACC plus Adani put together.
Right.
Number 3 will be Shree Cement.
Okay.
Then you have Dalmia Bharat and whatever.
Right.
Then it's fragmented again.
Right.
In the south as well now, that same market structure is sort of replicated. Not really. UltraTech and Ambuja are UltraTech and Adani at the top 2, yes.
Right.
Shree Cement is not dominant in south yet. Then Dalmia Bharat comes at a distant maybe 4th or 5th.
Understood.
So not there yet.
So you're saying that UltraTech was instrumental in sort of ensuring that the market isn't fragmented anymore, and I'm assuming this is where the acquisitions come in, right?
So this is, I think the market has not changed dramatically because these are very ongoing developments. So if I have to look at UltraTech's foray in the south, first they started organically. Then they acquired Kesoram in 2023, India Cement in 2024. These were the 2 acquisitions. Other than that, they have also in the past acquired Jayaprakash Associates and Century Textiles. Both of them were not South majority players, but they had some South presence,
Right.
Which helped them consolidate the share a little bit more. Now, with cement, one thing to understand is that despite this consolidation happening, on paper it has happened. So if I look at the market share of UltraTech Group, it is the highest. But if I look at the brands within it, it will be separate.
Right.
So India Cement has its own distinct brand. If I mean, imagine it was the first IPO in independent India has been existing for years.
Correct.
People have a very strong recall value for India Cement.
Right.
They have trusted distributors, they have trusted clientele. And see, cement sales can be divided into 2 parts. There is wholesale and retail.
Right.
Wholesale is where governments, large real estate companies, infrastructure companies are buying
Correct.
from you in bulk.
Right.
Here, the brand does not matter.
Yeah.
Pricing matters, product matters, and that's all.
Yeah, and your network maybe matters a little bit.
Network matters in whatever sense you want to say that. And on the retail front, brand matters.
Correct.
That's why cement companies are heavy on branding, are heavy
Advertising,
on
branding, yeah, correct. But that's all done from a retail point of view.
Yeah.
Right.
So that is if I am an independent house owner, I have got a contractor, I tell
Yeah.
him, boss, I want Ambuja Cement.
Correct.
Or I want UltraTech Cement.
And that's because you've probably seen the advertisements and Ambuja or UltraTech or whatever has created enough of a brand equity in your mind that you only want that because you feel secure, which is fine, right? But also what happens to, let's say, I mean, we've gone to huge government projects and then you're talking about an individual house owner, right? But what happens when it comes to, let's say, private builders? Because I'm assuming they are whether it's residential, whether it's commercial property
They
builders?
would come under bulk buying.
Okay.
They would come under bulk buying, and private builders or contractors typically will also look at how your RMC capability is. So buying cement is one thing, but if you want the concrete transported
Right.
from a plant nearby, number one, do they have a concrete mixing plant nearby?
Correct.
Are they good in their infrastructure of transporting?
Right.
How supportive are they in terms of services?
Right.
So it's a slightly different tangent.
Understood.
But overall, the service angle or the brand angle again matters when it comes to private builders.
Yeah.
So that will make a difference.
Correct.
So if I have to look at markets evolving over a period of time, yes, on paper and theoretically and numerically, UltraTech is still the largest, but India Cement brand is very strong.
Right.
So India Cement has its own distributors. Synergy will take time. Assimilation will take time.
Right.
You'll also realize that in a lot of these things, what happens is cement primarily is an industry where there is something known as manufacturing and distribution. The way it is optimized is that first there is something known as clinker made. Clinker are small pellets
Right.
of cement.
Right.
These are then ground into a fine powder, which is cement.
Right.
Usually, clinker capacity and grinding capacity are two different things.
Okay.
Companies will produce clinker in mass, then they will transport the clinker to 5 different places where there will be grinding hubs.
Right.
The cement will be ground there, warehouses will be there for further local supply.
Right.
Now, UltraTech will also realize that, boss, I have a grinding capacity in X place. In the same district, India Cement has a grinding capacity.
Right.
They'll try to optimize that.
Of course. Of course.
So when it comes to actual market share or the dynamics of the South actually changing,
Right.
it is a 3 to 5 year process.
Correct. Correct.
Wherein all this capacity optimization will happen. At the end of it, India Cement's plants are also old.
Right.
UltraTech with its balance sheet now comes in with the power to put in new plants, upgrades, waste heat recovery systems, split grinding facilities, pet coke usage, renewable energy, all that stuff, right? So once that starts happening, will you actually see the impact of it on pricing? Because right now, imagine India Cement's plants are old. They're incurring a certain cost per ton.
Right. Right.
UltraTech's plant is incurring a X minus something cost per ton.
Because they're more efficient than you are, etc.
Till the time there is parity between the two,
Right.
UltraTech can't play around with the pricing overall.
Correct.
So the regional problem of pricing, of dominance,
Right.
of low profitability will continue to remain till the synergies are completely matured in these
Right.
cases.
Right. And I'm assuming that will, as you said, it'll take about a 3 to 5 year time period.
Yeah.
So all of these acquisitions, right, whether it's Kesoram Industries, India Cements, Bharat Cement, this has all happened in the recent past,
In the last 2-3 years.
2 to 3 years.
Yeah.
Fair enough.
But there are some green shoots already visible.
Right.
Right. So, for example, if I have to look at the latest quarter, South pricing is almost very similar to the rest of the country.
Right.
So there is some amount of price parity which has already come into the market. If I look at the capacity utilization, South Indian cement firms are already they've upped from 50% to 70% in
Right.
terms of capacity utilization. It's still lower than the rest of the country, but still 50 to 70 is great progress. If I look at the realizations, they have gone from about 2,800 bucks per ton to about 3,300 per ton.
Right.
So clearly, UltraTech and Adani creating some amount of dominance has already resulted in benefits when it comes to improved pricing and profitability in the South.
Makes sense. Now, I mean, we've obviously spoken in a lot of detail about UltraTech, but in general, if you had to look at the cement industry, what do the valuations, profitability look like just as an industry as a whole?
Right. So the number one metric to track when it comes to cement companies is, or when it comes to the valuations of cement companies, markets look at only two things, I've figured.
Okay.
Number one is how much growth are they showing, the underlying cement company.
Right.
Or how much market share gain are they showing.
Fair enough.
And number two is the profitability of the company.
Okay.
Because at the end of it, whatever comes down as a profit is what goes into your balance sheet, and that is what makes a company
Right.
stronger. What happens in the case of a cement company is there is extreme price sensitivity to both pricing as well as raw materials
Right.
in order to gain EBITDA per ton
Right.
or
Right.
profitability, right? And that also depends how far you can stretch it, also depends on your growth. Because if you're not growing, and say your capacity utilization demand drops and your capacity utilization goes from 90% to 70%.
Your
profitability
your
gets
bottom
impacted.
line is screwed, basically.
Yeah. So basically, for valuations in cement companies, two things to look at: number one, growth; number two, profitability.
Understood.
Right. In the case of, and number three, I would add one more layer to it, is size.
Okay.
So pure sheer scale, ability to expand, ability to absorb shocks. So, for example, the South is going through a period of tough, whatever. There's a natural disaster. There is political change, and because of that, government projects have stopped.
Right.
Demand has dried up. Regional factors, whatever. Right. If a player is pan India, the impact on its financials will be lower.
Will be much lesser. Yeah, correct.
So typically, what we see is that the larger the player, the higher the premium. So UltraTech, Shree Cement, Adani now, but whatever. Let's again exclude Adani because it's very recent.
Right.
So Shree Cement, UltraTech Shree, Dalmia Bharat, were the ones which were getting a massive premium compared to the rest.
Understood.
Because of sheer size and scale and the operational efficiencies that come in, the brand recall, etc., etc. The regional players usually get a lower premium, especially in the south, because of the lack of pricing power. If you're so price dependent and that is the power you don't have, then you won't get the valuation.
Correct.
But that is not true of all regional players. There's a very interesting situation here where, for example, there is a company called JK Cement.
Correct.
So like South is very rich in limestone, even Rajasthan is very rich in limestone. Now JK Cement is Rajasthan based.
Okay.
It was supplying to north and west. Regional player. But it expanded very quickly. It set up new plants, tripled its capacity. It has a lot of limestone reserves. It was one of the fastest growing companies, and it traded at a valuation which was equivalent to the large guys.
Right.
So sometimes regional players can be an outlier and get that valuation.
Correct.
However, the dynamics have to be favorable from a regional perspective.
Makes sense.
So if I have to sum it up, there is size. So UltraTech will obviously come up there. Second is growth. Whether it is organically or through acquisitions, again, UltraTech is doing the right things. All the others are doing that as well. But pre-Adani, if I have to look at ACC Ambuja, there was a 10-year period before they got acquired by Adani where they were not growing at all. So imagine this, these guys were highest in terms of EBITDA per ton, but no growth. And hence the valuations were lowest. So now we're stacked up in such a manner that UltraTech is showing growth, it is showing profitability, it is showing scale. Ticks all the three boxes up there. Then you've got Shree and Dalmia, who've got scale, who are showing expansion. But in certain pockets, Shree is dominant in north and west, Dalmia Bharat in east, and they're trying to become pan-India very quick. Adani, through acquisitions, again,
has now got a tick on all their boxes.
All the three, but again, there are a separate set of issues with Adani Group companies coming under the radar for several other things, which will affect valuations. And then you've got South-based companies like India Cement, which UltraTech got for cheaper because it was trading at a lower valuation. But if it is able to attach its benefits to India Cement, that acquisition automatically becomes value creative. Right. So from that angle, I think we're in a place where regional players can be good acquisition targets. So we got to keep an eye on for smaller companies getting eaten up by larger companies who are obviously hungry for market share and price discipline, which may start emerging in the south.
Right. Okay, so this is a new section that we started. We've got something called as community questions. The idea is every week across our socials, people ask us a lot of questions regarding which stocks to pick, regarding personal finance, regarding investment strategies, etc. And every week we're going to pick one question and answer that. Right? This week we've got a question from Abhishek Patel. Are you ready?
Ready.
Within each category of mutual funds. So within each category, large cap, flexi cap, mid cap, small cap, there are multiple categories, and each category has 15, 20, 30 schemes. So how can Abhishek decide which scheme to pick within a particular category of mutual funds?
Spoiled for choice.
Yeah, that's what it is.
So 4-5 factors to keep in mind. Number one is reputation of the AMC itself, the asset management company, whether it is Kotak, HDFC, Axis, Parag Parikh, whatever. So you can do a simple rating of which one is reputed, which one has been existing for long, which one has good processes and systems in place. So a basic check of that should give you one preferred name there. Number two is which one has delivered consistent returns. And I'm not going to say only consistent, high and consistent returns. So you check out not only the returns for the last 1 year, but 3 years, 5 years, 10 years, however back you can go. Because at the end of it, 1 year performance is not going to determine the performance over
Right.
the lifetime. So you're going to check for longer durations.
Do you also compare these performances between different schemes?
So you compare. What I'm saying is a comparison between all the
Right.
schemes.
Right.
See which one is the most reputed or stands good in reputation.
Right.
Which one has delivered the highest and consistent, more importance on consistent returns. Number three, which offers the least expense ratio amongst these.
Okay.
Because you don't want to end up getting your returns eroded by the cost of management of the fund itself.
Right.
So highest return, lowest cost. You may want to look at fund manager consistency because a lot of the fund's performance depends on who the fund manager is.
Correct.
And if the fund manager himself or herself goes to another AMC or the AMC is not able to retain their fund managers for long, then there is inconsistent performance. So you want to look at who the fund manager is and whether they are consistent and up there or not.
Fair enough.
Yeah.
Okay, perfect. Sounds good. Please write in your questions on our socials, whether it's Instagram, Facebook, Twitter, YouTube. We're available on all our social platforms. That's it for this episode of Taking Stock. Thank you so much for listening. And we're going to be taking our episodes live every Tuesday. So stay tuned for next week. Thank you so much.
Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.